Assets equals liabilities plus owner's equity. This is the accounting equation. Here are some assets. With most assets, you debit positive on the left, credit negative on the right. Cash, you debit cash when you take it in. When you pay it out, you credit it. With inventory, some examples are with purchases, you debit. With transportation in, which is when the buyer pays free on-board shipping point, you would put that on the debit side. And with returns, discounts, allowances, cost of goods sold, you credit those. With supplies, things like office supplies such as pens, paper, pencils, those are things you will use within a year. You debit those when you get them, and you credit them when you use them. With accounts receivable, it's when you've carried out a good or services provided to another company or individual, and you are owed money but have not yet been paid. With equipment, things like your delivery truck or your farm's tractor. With prepaids, such as insurance, since you have not yet received the actual insurance, but you paid for it in advance, therefore it's an asset. And now things like allowances for doubtful accounts and accumulated depreciation, these are two examples of contra assets. With contra assets, you actually do it sort of the opposite. It's going to be positive on the credit side and negative on the debit side. Now, with contra assets, you never depreciate land or amortize goodwill.
So now we have the second portion of the accounting equation, which is liabilities and owner's equity. On this side of the equation, we have debits that will decrease the overall total and credits that will increase. Under liabilities, we have things called payables, and these include accounts payable, salaries payable, notes payable, and interest payable. And these are all when you owe other people or businesses or your employees, in the case of salaries payable, money, and you have just yet to pay that. With unearned revenue, that is when you've been paid a certain amount, but you've yet to complete the service, so you can't actually book it as revenue yet. With owner's equity, we have common stock, which is when you sell a part of your company and you get money for that, and then that's typically how businesses will start up. In the case of retained earnings, we have our red accounts, which are revenue, expenses, and dividends. And what you see here is how these three accounts affect the overall total of owner's equity and retained earnings. So with revenue, you have things such as interest revenue and service revenue, and then here is where you would debit returns, discounts, and allowances, because this will decrease the overall total of revenue as well as retained earnings and owner's equity. With expenses, you have things as operating expenses, supplies expenses, interest expenses, and also transportation out, which is when the seller pays, and that is FOB or free on board destination. With expenses and dividends, what you see here as markings is negative for the debit and positive for the credit, similar to the rest of these accounts. What you see here is how this affects the overall total of retained earnings and owner's equity, as previously mentioned. However, when you book an expense or dividends, you actually debit them because they increase, and they will increase the total of the individual account. However, like I said, they decrease the total of retained earnings, which they are closed out to at the end of the year, and they decrease total of owner's equity. With cost of goods sold, it's back to the normal with a negative debit and a positive credit, and that's fairly self-explanatory. It is the cost of the goods that you sold. So just as a recap for owner's equity, there is a debit of expenses and dividends, and there's a credit of common stock, and then revenue under retained earnings. So you have the liabilities and the owner's equity portion, which must equal the assets portion. And that is the recap of the accounting.